My dear students, welcome back to our channel. In this video, I will be explaining the Bcom 6th semester subject Cost Control Management Accounting as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 3. The first important short question is: 1. Define financial statement analysis. Financial statement analysis means studying a company's financial reports, like balance sheet and profit and loss account, to understand how well the business is doing. It helps us know if the company is earning profits or facing losses, able to pay its bills on time, growing or not growing. Example: imagine you want to invest in a company. You look at its financial statements. In 2022, profit is equal to 5 lakh rupees. In 2023, profit is equal to 8 lakh rupees. By analyzing this, you know the company is doing better and may be a good investment. Easy tip to remember: analysis is equal to study plus compare plus understand. It's like checking a student's report card to see if they are improving. Next important short question is: 2 objectives of financial statement analysis. Objectives of financial statement analysis. Financial statement analysis helps us understand how a company is doing. It's like checking a company's health report. Main objectives: 1. To know profit or loss. Example: if a company earned 5 lakh rupees last year and 8 lakh rupees this year, it's improving. 2. To check financial strength. Can the company pay its bills and loans on time? 3. To compare past and present. Is the business growing or not? 4. To help investors and banks. Should they invest or give loans? 5. To find strong and weak areas. Where is the company doing well? Where does it need improvement? Easy tip to remember: PCHGW is equal to profit, compare, health, growth, weakness. Next important question is: 3. Ratios meaning objectives. Ratios meaning. Ratios are like shortcuts that help us understand the financial condition of a company by comparing to related numbers. Example: if a company has 10 lakh rupees in sales and 2 lakh rupees in profit, profit ratio is equal to 2 divided by 10 is equal to 20%. It means the company earns 20 rupee profit on every 100 rupees of sales. Objectives of ratio analysis. 1. To know profit performance. Is the company earning well? 2. To check financial health. Can it pay its debts? To compare with other companies. Who is performing better? 4. To find strengths and weaknesses. Where is the company strong or weak? 5. To help in decision making. Should we invest or not? Easy tip to remember: ratios help us relax. Results: efficiency, liquidity, analysis. Example. Next. Unit 3. Important long questions. The first important long question is: 1. Ratios classification. What is ratio classification? Ratio classification means dividing ratios into groups based on what they tell us. Each type of ratio helps us understand a different part of the business. There are 4 main types of ratios. 1. Liquidity ratios. Can the company pay short-term bills? These ratios show if the company has enough money to pay its day-to-day expenses. Current ratio is equal to current assets divided by current liabilities. Example: if current assets is equal to 2 lakh rupees, current liabilities is equal to 1 lakh rupees. Current ratio is equal to 1, good. Quit ratio is equal to current assets, stock prepaid expenses, divided by current liabilities. To solvency ratios, can the company pay long-term loans? These ratios check the company's long-term financial strength. Debt to equity ratio is equal to total debt divided by shareholders' equity. Example, 5 lakh rupees loan, 10 lakh rupees equity 0.51 safe. Interest coverage ratio is equal to EBIT divided by interest. Shows if company can pay interest on its loan. 3 activity ratios. How efficiently is the company using its resources? These are also called turnover ratios. Inventory turnover ratio is equal to cost of goods sold divided by average inventory. High ratio is equal to good stock movement. Debtors turnover ratio is equal to net credit sales divided by average debtors. Shows how fast customers are paying. 4 profitability ratios. Is the company earning profits? These ratios show how well the company is making profits. Gross profit ratio is equal to gross profit divided by sales times 100. Net profit ratio is equal to net profit divided by sales times 100. Return on capital employed, ROCE, is equal to EBIT divided by capital employed times 100. Easy tip to remember. LSAP is equal to liquidity, solvency, activity, profitability. Learn it as lovely students always perform. Next important long question is: 2 from the following particulars of XYZ Limited. You are required to prepare a comparative income statement and also comment on the relationships revealed in the comparative income statement. Step-by-step guide to prepare comparative income statement. What is a comparative income statement? It compares the income and expenses of 2 years side by side and shows the increase or decrease in amount and percentage. Given data. Step 1. Calculate net profit for both years. For 2021, operating profit is equal to revenue operating expenses is equal to 58,000 minus 47,860 is equal to 10,140 rupees. Add non-operating income is equal to 150 rupees. Less non-operating expenses is equal to 200 rupees. Profit before tax, PBT, is equal to 10,140 plus 150 to 200 is equal to 10,090 rupees. Tax, 45%, is equal to 4,540.5 rupees. Net profit is equal to 10,090 minus 4,540.5 is equal to 5,549.5 rupees. For 2022, operating profit is equal to 66,200 minus 52,120 is equal to 14,080 rupees. Add non-operating income is equal to 640 rupees. Less non-operating expenses is equal to 240 rupees. Profit before tax, PBT, is equal to 14,080 plus 640 minus 240 is equal to 14,480 rupees. Tax, 45%, is equal to 6,516 rupees. Net profit is equal to 14,480 minus 6,516 is equal to 7,964 rupees. Comparative income statement of XYZ Ltd. Comment on the relationships. Sales increased by 14.14%, which is a good sign. Cost of materials also increased, but at a lower rate, 9.33%, which shows better cost control. Operating profit increased by 38.86%, which means the company is managing its core operations better. Non-operating income jumped by 326%, possibly due to extra income like interest, rent, or asset sale. Net profit increased by 43.51%, showing overall financial health improved. Easy tip to remember. Comparative is equal to compare amount plus percent. Focus on sales, cost less, profit more is equal to good. Next important long question is 3. Following is the profit and loss account of X Limited for the year ended 31st December 2019. You are required to calculate 1. Gross profit ratio, 2. Net profit ratio, 3. Operating ratio, 4. Operating profit ratio, V. Administrative expenses ratio. Given data from profit and loss account of X Ltd. 1. Gross profit ratio. Formula. Gross profit ratio is equal to gross profit divided by sales times 100. Gross profit is equal to 2,01,000 rupees. Sales is equal to 5,60,000 rupees. So, gross profit ratio is equal to 2,01,000 divided by 5,60,000 times 100 is equal to 35.89%. Meaning, it means the company earns 35.89% profit on every 100 rupees of sales after deducting the cost of goods sold, COGS. 2. Net profit ratio. Formula. Net profit ratio is equal to net profit divided by sales times 100. Net profit is equal to 80,000 rupees. Sales is equal to 5,60,000 rupees. So, net profit ratio is equal to 80,000 divided by 5,60,000 times 100 is equal to 14.29%. Meaning, it means the company earns 14.29% profit on every 100 rupees of sales after accounting for all expenses. 3. Operating ratio. Formula. Operating ratio is equal to operating expenses divided by sales times 100. Operating expenses is equal to purchases plus wages plus administrative expenses plus selling and distribution expenses. Purchases is equal to 3,50,000 rupees. Wages is equal to 9,000 rupees. Administrative expenses is equal to 20,000 rupees. Selling and distribution expenses is equal to 89,000 rupees. So, operating expenses is equal to 3,50,000 plus 9,000 plus 20,000 plus 89,000 is equal to 4,68,000 rupees. Operating ratio is equal to 4,68,000 divided by 5,60,000 times 100 is equal to 83.57%. Meaning, it shows that 83.57% of sales are used to cover operating costs, example, purchases, wages, administrative expenses. 4. Operating profit ratio. Formula. Operating profit ratio is equal to operating profit divided by sales times 100. Operating profit is equal to gross profit minus operating expenses is equal to 2,01,000 rupee minus 4,68,000 rupees is equal to minus 2,67,000 rupees. Operating profit ratio is equal to minus 2,67,000 divided by 5,60,000 times 100 is equal to minus 47.68%. Meaning, this shows a negative ratio, meaning the company's operating profit is negative, indicating it's making a loss on its regular operations. Administrative expenses ratio. Formula. Administrative expenses ratio is equal to administrative expenses divided by sales times 100. Administrative expenses is equal to 20,000 rupees. Sales is equal to 5,60,000 rupees. So, administrative expenses ratio is equal to 20,000 divided by 5,60,000 times 100 is equal to 3.57%. Meaning, it shows that 3.57% of sales are used for administrative expenses. Easy tip to remember the ratios. Gross profit ratio is equal to sales profit after COGS. Net profit ratio is equal to overall profit after all expenses. Operating ratio is equal to cost to run the business. Operating profit ratio is equal to profit from core activities. Administrative expenses ratio is equal to cost for admin work. Next important long question is: 4. Following is the balance sheet of Universal Manufacturers Co. Ltd. Calculate the following ratios: A. Current ratio, B. Quick ratio, C. Debt equity ratio, D. Assets turnover ratio if sales are 19,60,000 rupees, E. Proprietary ratio. Given data from the balance sheet of Universal Manufacturers Co. Ltd. Total liabilities 9,80,000, total assets 9,80,000. A. Current ratio. Formula: current ratio is equal to current assets divided by current liabilities. Current assets is equal to cash in hand plus cash at bank plus debtors plus bills receivable plus stock plus prepaid expenses is equal to 3,80,000 rupees. Current liabilities is equal to creditors plus bills payable plus outstanding expenses is equal to 1,30,000 rupees. So, current ratio is equal to 3,80,000 rupees divided by 1,30,000 rupees is equal to 2.92. Meaning, the company has 2 rupees and 92 paise in assets for every 1 rupee in liabilities, which means it can easily cover its short-term debts. B. Quick ratio, also called acid test ratio. Formula: quick ratio is equal to current assets minus inventory minus prepaid expenses divided by current liabilities. Inventory, stock, is equal to 1 lakh rupees. Prepaid expenses is equal to 10,000 rupees. Current assets is equal to 3,80,000 rupees as calculated above. Current liabilities is equal to 1,30,000 rupees as calculated above. So, quick ratio is equal to 3,80,000 minus 1 lakh minus 10,000 divided by 1,30,000 rupees is equal to 2,70,000 rupees divided by 1,30,000 rupees is equal to 2.08. Meaning, the company has 2 rupees and 8 paise in liquid assets for every 1 rupee in current liabilities. This indicates it can easily meet its short-term obligations without relying on inventory or prepaid expenses. C. Debt equity ratio. Formula: debt equity ratio is equal to total debt divided by shareholders' equity. Total debt is equal to debentures plus bank loan is equal to 2 lakhs rupees plus 1,50,000 rupees is equal to 3,50,000 rupees. Shareholders' equity is equal to equity capital is equal to 5 lakhs rupees. So, debt equity ratio is equal to 3,50,000 rupees divided by 5 lakhs rupees is equal to 0.7. Meaning, the company has 70 paise in debt for every 1 rupee of equity. A lower ratio suggests the company is less reliant on debt for funding. D. Asset turnover ratio. Formula: asset turnover ratio is equal to sales divided by total assets. Sales is equal to 19,60,000 rupees. Total assets is equal to 9,80,000 rupees. So, Asset turnover ratio is equal to 19,60,000 rupees divided by 9,80,000 rupees is equal to 2. Meaning, the company generates 2 rupees in sales for every 1 rupee invested in assets. A higher ratio indicates better use of assets in generating sales. E. Proprietary ratio. Formula. Proprietary ratio is equal to shareholders' equity divided by total assets. Shareholders' equity is equal to 5 lakhs rupees. Total assets is equal to 9,80,000 rupees. So, proprietary ratio is equal to 5 lakhs rupees divided by 9,80,000 rupees is equal to 0.51. Meaning, 51% of the company's assets are funded by the shareholders' equity, showing a strong foundation from owners' funds. Easy tips to remember the ratios. 1. Current ratio is equal to assets for short-term liabilities. Shows short-term debt-paying ability. 2. Quick ratio is equal to liquid assets liabilities. Shows ability to meet short-term debts without relying on inventory. 3. Debt-equity ratio is equal to debt-equity. Shows how much debt the company uses compared to owners' funds. 4. Asset turnover ratio is equal to sales total assets. Shows how efficiently the company uses assets to generate sales. 5. Proprietary ratio is equal to equity total assets. Shows the proportion of assets funded by shareholders' equity. Quick recap. Current ratio 2.92 great short-term solvency. Quick ratio 2.08 strong liquidity. Debt-equity ratio 0.7 lower debt good equity base. Asset turnover ratio 2 efficient asset use. Proprietary ratio 0.51 healthy equity proportion. Next, mini quiz to test your learning. 1. What is the formula for the current ratio? 2. If the quick ratio of a company is 1.5, what does this tell you about its ability to pay short-term debts? 3. A company has a debt-equity ratio of 0.5. What does this imply? 4. What does the asset turnover ratio of 3.0 indicate? 5. If a company's proprietary ratio is 0.65, what does it mean? Answers. 1. Current ratio is equal to current assets divided by current liabilities. 2. A quick ratio of 1.5 means the company has enough liquid assets, excluding inventory, to cover its short-term liabilities. 3. A debt-equity ratio of 0.5 means the company uses 50% debt for every 1 rupee of equity. This is relatively low risk. 4. Asset turnover ratio of 3.0 means the company generates 3 rupees in sales for every 1 rupee of assets. 5. A proprietary ratio of 0.65 means 65% of the company's assets are financed by shareholders' equity. I hope you understand easily each question. All the best students for your upcoming exam. For other subject quick revision. Important questions. Previous question papers. And syllabus. Links are available in description. Check out once. Thank you for watching. Like and share this video with your friends.